Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Tuesday, May 12th, 2026, and Wall Street felt like two markets in one. Not a panic, more like a cautious de-risking. The AI and chip winners cracked hard, while defensives quietly kept the S&P 500 from breaking. The headline move looked tame, but the tone underneath? Heavier. Zoom into the S&P 500 heat map, and it's a violently divided picture. A lot of green until you notice where the red is concentrated. The semiconductor block is the epicenter. Meanwhile, healthcare and consumer staples look uniformly bid, helping the index mask how intense this rotation really was. That heat map split? That's basically your flow map. Money rotated out of high beta AI and semis and right into defensives and value. Healthcare and staples did the hiding. Financials participated too. On the flip side, software and the chip trade became the funding source. It's exactly why the Dow held up, while the Nasdaq and Russell felt the air come out. So what's the tension driving all this? The market was digesting a hotter CPI backdrop, while oil was climbing, fueled by that Iran war energy shock in the background. That combo hits duration and high multiple winners first. Here's the key point. This didn't look like sell-all equities. It looked like traders trimming what was crowded and postponing the bigger decision to the next macro cat. On the chatter, we didn't have a specific verified rumor feed today, but what we did have was the kind of desk narrative that spreads fast: yields repricing, oil shock, crowded AI unwind. It's useful context, sure, but unverified in the moment. The tape itself is what confirmed the rotation. Chips down, defensives up. Let's go stock by stock, starting with Qualcomm, QCOM. It dropped over 11% as the semiconductor complex got slammed in this risk-off rotation. Moves like that? They aren't just one-name stories. They signal the market is actively degrossing chips, and that tightens intraday risk across high-beta tech. AMD was another clean confirmation point. The stock fell over 4%, sold right along with the broader chip complex as traders dumped high-beta AI winners. When AMD is red like this on a day where defensives are green, it reinforces that the pressure wasn't isolated. It was sector-wide. Now, here's the standout divergence. Nvidia, NVDA, actually finished up 0.5%, even while the rest of the semiconductor space was taking a beating. That's a high-signal split. Either Nvidia is becoming the last safe AI refuge, or it's simply the last domino that hasn't fallen yet. Microsoft, MSFT, was part of the heavyweight drag, down over 1% as mega-cap software and AI-adjacent growth stayed under pressure in the broader de-risking move. With a stock like Microsoft, even a modest decline matters. It's a massive index weight, adding real torque to that Nasdaq weakness. Apple was one of the few mega-cap generals that actually held up. AAPL gained almost 1% during a Nasdaq down session. That reads like a rotation within tech, moving toward perceived quality and defensiveness, rather than just uniform selling across everything with a tech label. And Netflix stood out on the upside. NFLX jumped over 2.5%, showing idiosyncratic strength while the market rotated defensively. The story here wasn't one single dominating headline. It's more about a shift in investor focus toward pricing power, advertising, and content spending. In a risk-off tape, clean, green outliers like Netflix become safe growth parking spots. Looking ahead, the near-term question is follow-through. Watch how markets reprice inflation and rates after today's CPI shock, especially any continuation in yields and dollar-sensitive flows. Oil is the other lever. More energy upside keeps that sticky inflation pressure right on growth. As for the calendar next week, Tuesday, pending home sales. Wednesday, FOMC minutes. Thursday, jobless claims, Philly Fed, and flash PMIs. Friday wraps with U of M sentiment on the tape. Keep a close eye on the chip leaders, Nvidia, AMD, Qualcomm, and watch oil sensitivity via names like Exxon, XO. Bottom line, today was a rotation day, not a full exit from equities. The S&P headline looked calm, but the internals were tense. Chips and high multiple growth took the hit, while defensives did the stabilizing. For the next session, watch whether leadership broadens back out, or if the selling in semis keeps bleeding into the rest of growth. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.